Good afternoon, ladies and gentlemen. Hello, my fellow traders. My name is Michalis. I am one of the market analysts here at HF Markets. I'd like to welcome everybody to another webinar. Of course, like with all webinars, I don't want people to think of this as a lecture. I'm not a lecturer. I'm a trader. I'm a financial advisor. I sit here and I trade, just like individuals here at home as well. So I want you to think of me as somebody that you're speaking to. Think of it as a podcast. Think of it as a discussion, an educational discussion, shall we say. So as always, and we saw this in yesterday's session as well, ask questions, ask a lot of questions. Tell me about your experience. If there's something since our last webinar that you've experienced, maybe something you found useful, maybe something you found extremely difficult, maybe something that you don't understand. Tell me about it, ask questions, we'll discuss it as a team together, and we'll look for the remedy. So this is always what I want people to go away from the webinar, to fully understand, but not only to understand the theory, to understand how to use it straight away as part of their trading, how to benefit from it, how to use it to their advantage, and if they have certain difficulties while trading, and this may be the reason why certain trades experience a loss, or maybe why they may be struggling. What is the solution? What is the remedy to this so it does not occur? So this is what we want to, of course, achieve as part of our webinars. Now, today's webinar, we're going to be looking at fundamental analysis. Now, the webinar is going to be split up into two sections because I'm going to look at fundamental analysis in terms of just educational. What is fundamental analysis? Is it accurate? How can you use it? Why is it used? By who it's used? And so on and so forth. But something more important, I think, is how to sit there on your phone or in front of the MT5 and use it today. Use it straight away. How can I use today when I'm analyzing the market? Let's say I'm a beginner. I analyze the market. I trade. I've been trading for a month, and maybe I have a 50% success rate. How is this webinar? How is fundamental analysis going to take me from a 50% success rate to a 60% success rate to a 55, 65, whatever it may be? How is fundamental analysis going to benefit me? Because I do a lot of research, and as part of my research, I look at lots of different webinars. I look at what people are talking about on YouTube. There's a lot of educators there on YouTube. I can guarantee you, no educator on YouTube is a successful trader. None of them are licensed. None of them are financial advisors. What they're speaking about, it may sound great, but it's not something which works in the real market. So this is what I want, where I want to be different. Today we're speaking about fundamental analysis. How can fundamental analysis benefit you as a trader, as an individual? This is what I want to speak about. I've got 3 people that have already asked questions. I'm going to look at those in a moment. Guys, again, this isn't a lecture. This isn't just a presentation. You sit there with a pen and paper, write notes, and that's it. Ask questions. Tell me about how we can help you as part of today's webinar session. Now, as part of this slide, very quickly, we're going to do a very quick introduction. As part of this slide, I want everybody to be aware, we're not here to tell you what to trade. We're not here to give you financial advice or investment advice and so on and so forth. What we want to do is to ensure you have the knowledge to be able to be active in the financial trading market with confidence, with expertise, to know exactly what you're doing, etc. Very, very quickly, a little bit about myself. I already mentioned, I sit here and I trade, and I'm a trader, but I'm not like those other individuals on YouTube. I've been in the market for 10 years. Almost 5 of those years, I was a financial advisor in London. I'm a licensed financial advisor in the European Union and in the UK as well. If you go to CISEC's website, you'll actually be able to see me on the list of certified individuals. So this is a little bit about myself. What I want to do, though, is to be able to provide that knowledge to individuals who are looking to get started in the financial trading markets. And I would like to do a bit of an introduction because I want people to feel comfortable speaking to me. Now, I've got some questions. I'll very quickly answer these questions. You spoke about Forex futures on FinViz, how to read or analyze FinViz Forex futures for fundamental news. Yes, I did. Since you mentioned it, because on the second half of the webinar, I will go on to the MT5 and show you how to take fundamental analysis and incorporate it while trading live on the actual live charts, real time, the real platform itself. Since you mentioned FinViz, I don't quite understand the question, but since you mentioned FinViz, I will include FinViz as part of that so people can get a better understanding of that. So towards the end of the webinar, I will include FinViz, how to analyze it, because FinViz is actually related to fundamental analysis. So I will use that when we're on the MT5. So you haven't asked a question, it's more of a statement. Hopefully when I'm using it, you're getting a better understanding of how to use it. Where can I get a PDF? We don't provide PDFs. All webinar recordings will be sent to you. So you have the presentation on the recording, and you can watch it, fast forward, rewind, and so on in your own time. Another person has asked for PDFs. Another person has asked for handouts. We don't provide handouts, ladies and gentlemen. We provide you with the recording. Now, before we get started at looking at this page, before we get started at looking at fundamental analysis, let's very quickly do a poll because I'm very interested to see what people think. And to be honest, I think everybody else watching wants to know what people think as well. Tonight, we have a major announcement, such a big announcement. There's going to be a lot of volatility. There's going to be new trends. There's going to be stronger trends. Such a big event. It's the first time the Federal Reserve is about to cut interest rates in more than 4 years. 4 years. It's the first time in more than 4 years. The big question is there going to be a 25 basis point rate cut, or is there going to be a 50 basis point rate cut? What do you believe? So far, 40% of viewers have answered. Let's at least get 70% of viewers answering the questions. And I will share the results with you. So I will tell you what people voted. So you can also maybe take that into consideration as you're trading throughout the day. 55% of people have voted. Let's go to 70, guys. At least 70% of people voting, and I will confirm to you what people have voted. I'll give people 10 more seconds. We only need one more person to vote now. 5, 4, 3, 2. There we go. All right. So let me share this with you. So I'm going to end the poll, and I will share the results with you. There we go. So you're able to see this. So from everybody that voted, 78% believe there's going to be a 25 basis point rate cut. 22% believe there's going to be a 50 basis point rate cut. That is very, very interesting. Now, this, ladies and gentlemen, potentially, for example, could be something which is negative. If we're going to get 25 basis points, it could be negative for gold and for US stocks. Whereas if we're going to get 50 basis point rate cuts, then it definitely can be very strong for gold, for example, potentially, and also for the US stock markets. Why? Because people may say, you know, any interest rate cut is positive. To be honest, I'm not going to speak about that just yet. We'll get to that page and we'll speak about it because I want to go through everything step by step. So let's continue. The idea of fundamental analysis. So I want people to understand what fundamental analysis is, but why do people look at it? Now, everybody needs to know there is 3 types of analysis methods. Some people think there's 4, but there isn't. There is 3. Now, the first one is technical analysis. And to be honest, most beginners, they look at technical analysis mainly. Now, there's benefits to technical analysis, and technical analysis can be very powerful. But there is a specific disadvantage to technical analysis as well. And that is because technical analysis is the last thing that happens that you can analyze, okay? So it's like, for example, I can see here, because GoToWebinar gives me statistics, and I can see 80% of people here are male. So I'm going to give you an example in terms of a football match. Technical analysis is like analyzing the score at the end of the match. The match is finished, okay? It is the last thing that people would do. For example, you can analyze the players before the match. You can analyze injuries before the match. You can analyze during the match. But then you can also analyze after the match and analyze the score. Technical analysis is the last thing that you are analyzing. So yes, it's very powerful. Beginners use it because it's one of the easiest ways of analyzing the market. So yes, of course, that is a benefit as well. The disadvantage is that it's the very last thing which takes place. So this is a disadvantage because you're analyzing the price movement, but the price movement is actually happening or has already happened. So that's a disadvantage. Then you've got order flow analysis. Now, a lot of people say to me on a lot of webinars, the big boys, JP Morgan, Goldman Sachs, Charles Schwab, BlackRock, all these very big market players, how are they analyzing the market? A lot of people say that to me, you know, because they say to me, I'm pretty sure they're not looking at the trend line. And you're correct, they're not. They use order flow analysis. Professional traders as well. For example, myself, who's been a trader for many, many years, I use order flow analysis tools as well. So order flow analysis, basically using certain tools which will show you different things which are related to the amount of orders. So how many people are buying, how many people are selling, what's the volume, at which prices are they buying and selling, what is the average price people are buying at, and so on and so forth. So this is kind of in the middle, all right? Because it is the orders, it is the buy positions and the sell positions which are triggering the price movement. So it's not technical analysis. Technical analysis is analyzing the price movement. But for that price movement to happen, people have to analyze something before. And this is order flow analysis, because it's analyzing what are people opening in order for that price movement to actually happen. So that has a lot of benefits as well. And we can go even further back, okay? And this is where fundamental analysis comes into it. Because a lot of beginners, they think fundamental analysis is looking at the news is released, and then I'm going to open my position based on the news and the price movement. This is very poor, weak fundamental analysis. And to be honest, it's actually more like technical analysis, because you're actually just looking at the news, but then you end up trading the price movement. And if you're trading the price movement, you're looking more at the price action, then that's actually technical analysis. So that's not fundamental analysis. This is weak fundamental analysis. Fundamental analysis is basically looking at certain things within the market. That could be news, but most of the time it's not news. But you're looking at certain things within the market. It could be investors' risk appetite, it could be sentiment, it could be economic growth, it could be monetary policy, it could be forward guidance, it could be quarterly earnings reports. There's a million things that we can potentially look at. But it's basically sitting here and looking at different factors within the market and looking at these factors and saying, is this information going to make somebody sell, or is it going to make them buy? So if you're a shareholder, are you going to, because of that piece of information, sell your shares? Okay, because if it is going to make you sell your shares, then of course I'm going to take that into consideration. I can look at certain ways of using that as a signal as well. So this, ladies and gentlemen, is the very first thing, because technical analysis is the price movement as it's happening. Order flow analysis, it is the orders which is going to trigger the price movement. Fundamental analysis is what is going to happen to prompt somebody to buy or prompt them to sell what they already hold. So this is extremely, extremely important as well. This is the idea of fundamental analysis. So fundamental analysis looks at what will cause investors to open or close certain positions. Fundamental analysis is a method used by investors and traders to evaluate the intrinsic value of the asset. Now, what does that mean? They're basically going to use this information, say the assets of the price is, let's say, at 100 US dollars, for example, it could be a stock, and they're going to look at different things in the market. For example, if they're looking at that stock, they're going to say, what is the value of all the other stocks within that do those companies that do the exact same thing as that company? What is the value of them compared to this stock? Okay, what is the value of companies which are the same size as that company? So maybe they're not in the same sector, but they're the same size as that company. What is the growth, okay, in sales and the growth in earnings compared to the stock price, compared to other companies witnessing the exact same thing? Let's look at the value, but let's also look at economic growth, and let's look at economic stability. And they say to themselves, what is the true value of that asset? Because most of the time, the true value of that asset is going to be different to that actual value of that asset. When that is actually taking place, and there is deviation there, is there where very large investors will place certain positions because they'll trade the correction back up to that price or back down to that intrinsic value. Somebody which is very well known for doing this for at least 40 years is Warren Buffett, okay? Fundamental analysis evaluates whether certain data will trigger higher or lower demand. Fundamental analysis includes economic data, fiscal data. Fiscal data is basically data coming out of the government, monetary policy, so basically the policy of the central bank, earnings data related to companies, geopolitical elements, and environmental data. Now, people probably are going to say to me, you know, economic data, yes, okay, it's understandable. The government, understandable. The central bank, okay, understandable. Why environmental data? But to be honest, we're going to look at it step by step, and we're going to look at everything here, okay? Because a lot of people may even be saying, you know, what's monetary policy? Never heard of monetary policy before. And we're going to look at this step by step. I've got some questions. Very, very quickly, I'm going to answer these questions. Bear with me, ladies and gentlemen. Is there a place to look for this information? At the very end of the webinar, we're going to go onto the MT5, we're going to go onto Google, and I will show you how to find this information. A lot of people are going to say, go to the calendar. The calendar gives you nothing. The calendar gives you 10%. I will show you how to get access to this information and how to include it as part of your analysis. So your success rate and the way you're trading becomes much more enhanced. Is order flow analysis the same as market sentiment? No. So market sentiment is looking at, you know, what's the sentiment of investors towards this asset, towards this price that I think is too expensive. Are they happy to invest in this market? What is the risk appetite of the market in general? Order flow analysis is basically saying, within this hour, 10,000 people have bought this stock, 2,000 people have sold this stock. So there's a 5-to-1 ratio in favor of buyers. So I'm going to take into consideration speculating the price is going to continue to increase. It's looking at the orders, how many buy positions, how many sell positions. This is an example of order flow analysis. Which factors of analysis affect indices? We're going to look at certain things today. I'll give you a quick snapshot. We're going to, for example, take into consideration the VIX index. We're going to take into consideration the high-low index. We're going to take into consideration how to use bond yields, how to use global indices as an index, as an indicator as well. That's just a very quick snapshot. Somebody here says, can you give me an example of order flow tools? Of course I can. So some very well-known order flow tools is something known as a volume weighted average price. That's not a moving average, it's very different. Volume weighted average price. Another tool is, for example, cumulative delta. Another tool, for example, is order flow charts. But there's quite a lot. Volume profiles, for example. There's a lot of things that you can look at. These are just a few that you can write down and do some research yourself with. So is fundamental analysis accurate? So fundamental analysis isn't the same as news trading. Yes, fundamental analysis is accurate, but fundamental analysis is not there to confirm whether you should be entering or whether you should be exiting. This is why, ladies and gentlemen, news traders have a very high percentage of losses, of unsuccessful trades. News traders have a very high percentage of unsuccessful trades. This is why also a lot of the time, because people that are news trading may have, for example, only a 40% success rate, they try to have a very high reward to risk ratio, because they say to themselves, okay, if only 4 out of the 10 trades I open are going to be successful, I want to make sure those 4 are very successful. So I'm still profitable, even though I've got a very weak success rate. So fundamental analysis is not there, and it's not known by professional traders to be a way to be able to consider when to enter and exit the market. Even professional traders and very large institutions that concentrate mainly on fundamental analysis, they will say, yes, because of XYZ, I want to buy, and that is fundamental analysis. But then they'll go back to algorithms, they'll go back to order flow, they'll go back to technical analysis and use that to determine their entry and their exit. So keep that in mind. This is the first mistake we don't want to do. Some people may say, okay, if you're not going to show me how to use fundamental analysis to enter and exit, it's useless to me. I want to know how to enter, find the best trade, find the profitable trade, find the successful trade, and exit and capitalize on that profit. I will show you how to use fundamental analysis when taking into consideration trades. But it's a scenario where you've got this signal, okay, maybe a crossover, maybe something related to technical analysis, but then you're going to say, if XYZ is not happening on fundamental analysis, then I'm not taking that trade into consideration. Or because of XYZ, I want to now start to look at where there's going to be a buy signal. So it's about marrying up technical analysis and fundamental analysis to be able to, yes, look at technical analysis to pinpoint where to potentially buy, to potentially sell, but to use fundamental analysis to take your success rate from 50% to 70%, or for example, anything else to improve your success rate. For fundamental analysis to be accurate, investors either need to use it alongside technical analysis or order flow. Of course, if people are building a portfolio is great. People sometimes prefer it. There's a lot of benefits to, instead of trading, building a portfolio. That's absolutely fine. People that are building a portfolio, then yes, of course, they may look to solely use fundamental analysis. Otherwise, traders, people trading with leverage, fundamental analysis, order flow, technical analysis, let's marry the two up together. This is what we're going to do today. And I'm going to give you an example. So here, ladies and gentlemen, we're looking at an announcement, recent announcement, doesn't matter which announcement, it's just an example. But a recent announcement is on NASDAQ. And the announcement, ladies and gentlemen, if we're going to follow theories, the announcement was negative. The announcement took place here. You can see I've got a red line there as well to pinpoint where the announcement was made. This is where the announcement was made. It was significantly negative for the NASDAQ. So a lot of people would have expected the price to do something like this. That is the theory. Didn't do anything like that, guys. At first, it increased all the way up to here. Yes, okay, after that, it did decrease. So if people held on to it, then they would have gone into a profit. But then it just moved completely in the opposite direction. So nobody would have wanted to sell at the news. Nobody would have wanted to sell shortly after the news, for example, in this area. But you can see that fundamental analysis is accurate. And you can see eventually it does, after many days, start to move in that direction. A lot of people in the financial trading markets, they say to people as well, especially institution, one of the first things they talk about when you're in an institution and you're an analyst or strategist in very large companies. For example, I was in Platinum in London. They say to you, you buy the news and you buy the rumor and you will sell when it's released. Okay, buy the news, buy the rumor, sell the news. Okay, that's something also for us to take into consideration. So let's start looking now that we've got a good understanding. Okay, we know what fundamental analysis is. We know what the other approaches are as well. We know fundamental analysis is accurate. We know fundamental analysis isn't to be used as a signal. We know fundamental analysis is the analysis of certain things happening within the economy, within the world, within the government, within the company, and using that information to determine, is that going to trigger a higher demand? Is that going to trigger a lower demand? And using that to be able to consider when to buy and when to sell. So let's start now by looking at very simple ways of including fundamental analysis as part of our analysis. Now here we're going to look at the theory. In a little while, we're going to go on to the MT5 and use this as part of the MT5 and as part of our analysis. So we'll do it live, guys, in live real market. Very quickly. Somebody here says, are you trading the Fed cut this afternoon, today, he says. Yes, of course, I will. I won't be trading news release. I will be trading at least 30 minutes after. But of course, because I want to be cautious about volatility, me personally, everybody can have their own, of course, take in regards to that. He's asked some other questions if I think it will be 50 or 25 basis points. Of course, I don't ever confirm that. What I will say is, me personally, I may have my opinion, but to be honest, whether it's going to move up or down, whether it's going to be 25 or 50, I'm prepared. I know exactly where I'm going to trade, no matter what type of price movement it is. I know if I see X type of price movement, I'm going to buy. If I'm going to see X type of price movement down, I'm going to sell. What I will say is, we had a poll at the very beginning, probably you missed it. That's absolutely fine, of course. We said, by how much will the Federal Reserve cut tonight? 78% of people watching today's webinar said 25 basis points. 22% said 0.50%. So most people think it's going to be a 25 basis point rate cut. So let's look at stocks and how stocks are correlated. The first thing I want people to be aware of, let's go through these bullet points, but what I want people to be aware of is stocks, they are correlated. What does correlated mean? It means they are linked, okay? And people, they look at a stock because they're trading a stock, and they look at it as an individual asset. Or people may look at an index. For example, the NASDAQ has become very popular. They may look at the NASDAQ and they may look at it as an individual asset. This is a mistake. This is what fundamental analysis is saying for us not to do. Stocks are correlated. The whole stock market is correlated. There's, of course, arguments whether the global stock market is correlated or if it's just the US stock market is correlated between itself and the European stock market is correlated between itself. Most people think the global stock market, generally speaking, is correlated to a certain extent, of course. So think of it this way, okay? When we look at it, if I say to you, within the NASDAQ, we have 100 stocks. 99 of those stocks are decreasing in value today. One of them is increasing in value today. Do you want to buy that stock? I'm willing to sell it to you. Do you want to buy that stock? You're going to say, no, I'm not buying that stock. You're sitting here telling me the NASDAQ, technology market mainly, 99 stocks are decreasing and only one is increasing, and you're telling me to buy that stock. I'm not going to buy it. Whereas if I come to you and say, look, the NASDAQ, 100 technology-based companies, massive AI boom, from the NASDAQ, 95 of those stocks are increasing in value. I've got a stock here which is also increasing in value, which is part of the NASDAQ. It's actually one of the best performing stocks of the NASDAQ. Do you want to buy that stock? You're going to say to me, yeah, I'll take that into consideration. So you can see here, stocks are correlated. The way investors like myself, investors, even bigger investors than me, the way they think, okay? So stocks are correlated. What we need to understand is, how can I use that as part of my trading? I've got a lot of questions here, guys. Let me finish the screen, and then we'll answer all questions. So when a large portion of the world's stock market is performing well, it will influence other regions as well. I'll give you an example. Asian stocks, the first things that start trading. Let's say all Asian stocks are performing great today, performing amazing. Then the European market opens. Asian stocks still continue to do well. European market stocks now are open. European stocks are actually doing well now. So the US stock market is about to open. Nothing has really changed in the market. There's not been a new war. There's not been an interest rate hike. Nothing else has changed. Are you going to speculate that the NASDAQ, S&P 500, Dow Jones is going to increase in value as well? Or do you think they're going to be the only ones that are going to decline in value? Yes, of course, they can decline in value. It is a possibility. It's a different session. But definitely you're going to use that as an indication that the US market potentially can do very well as well. So that's something very important. The most important stock markets are the US, the EU, Asian, specifically for Asia, China, and Japan. I don't want you to go into very small stock markets. It's useless. There's no point doing so. So for example, I don't want you to look at the Hellenic 35, which is a very small stock market. If you're looking at European stocks, I only want you to look at, for example, the Euro Stock 50, the DAX, the CAC. If you're looking at Asian markets, you're not going to look at, for example, the Filipino index, which holds 2,000 very small companies. No, you're going to look at the Nikkei 225 for Japan. You're going to look at the Hang Seng for China. So again, keep that in mind. Stock markets are more grouped than previously. If we go back 20 years, stocks and analysis was more based on individual companies. So a lot of people, by the way, they watch things like, for example, interviews with George Soros, with Warren Buffett, with a lot of other well-known analysts, and they speak about, look at the individual stock, look at the individual accounts, the really old people, and they say analyze their accounts if they're doing very well, and if you think they're trading below their intrinsic value. Yes, that was the way people analyzed the market back then. It's not the way people analyze the market now. So analysis of the stock market is definitely more grouped than it used to be. And this is also why a lot of people, whether you're building a portfolio or trading, they concentrate more on ETFs, grouped indexes, the Nasdaq, S&P 500, the Dow Jones, and so on and so forth. Poor stock market movement is deemed as positive for the dollar or gold. Sometimes it can be both. Why? Because they're both safe haven assets. Now, a lot of the time, we're going to either see investors rush to the dollar, and gold will also decline because of that, or they'll rush to gold, and the US dollar will decline along with the US stock market. Sometimes, though, there is scenarios where both increase in value as well. And of course, we have to take into consideration vice versa. So positive stock price movement can be negative for the US dollar as well. Now, positive stock price movement is also deemed as positive for cryptocurrencies. A lot of the time when stocks are doing well, cryptocurrencies are doing well. What I will say is you need to be cautious there, because it doesn't mean if stocks are doing well today, cryptocurrencies will do well today. It's more longer term. So if stocks did well in these 6 months, most likely cryptos did well in these 6 months. A lot of people are going to say, why? And I'll explain. Because the market is all based on risk appetite. It's such a big thing. A lot of people say, what's the most important thing? Risk appetite. That is the most important thing. If you can determine the market's risk appetite, that is the most powerful tool in the market. Okay? So the market's risk appetite. Okay? So why are stocks and cryptos connected, should we say, and their performance connected? Because if people have a low risk appetite, people are thinking to themselves, I'm just so cautious at the moment. I'm so scared. The economy is terrible. I just want my money to be safe. That's all I care about. If people are starting to think like this, that's not good for stocks. Okay, why? Because stocks, there's risk. It's a risk-based asset. The stock price can fall. If they were paying you dividends, they may stop paying you dividends. Cryptocurrencies. Cryptocurrencies is a very risky asset as well. Why? Because it's very volatile. So I'm not interested in that. I'm like, guys, just I want cash, I want savings accounts, I want a fixed account. That's the only thing I care about. So they both perform terrible together. But if I'm like, I'm fed up with my bank account, I just want to earn money, I want to invest, I want to take on risk, I want to try and have a secondary income, and I want to profit, and X, Y, Z, and all these different thoughts are going through my mind. If everybody's taking this view within the market, then of course there's a very big chance people are going to start turning towards these two options, stocks and crypto. So both of them increase simultaneously or decrease simultaneously as well. Now, very quickly, I'll answer the questions. Very, very quickly. I'm 16 years old. I'd like to know more about Forex trading. Keep in mind, if you're under 18, it's illegal around the whole world to be trading, to be investing, to be trading, anything. What you can do, of course, is you're more than welcome to look at education and educate yourself for 2 years and then start trading. And to be honest, you're going to be ahead of everybody else because you've been educating yourself for 2 years already. So that answers that question. Now, bond yields, US bond yields. Now, what exactly are bond yields? Bond yields, very quickly, before I start looking at how you can use it as part of fundamental analysis. Bond yields is very simply the government, let's say the US government, for example, they say, we have to make a new highway. This new highway is going to cost $1 billion US. I don't have 1 billion US dollars as the US government. So what do? They go to the market, the bond market, the bond exchange, bond bureau, whatever you wish to call it, and they say, I need to raise 1 billion US dollars. I will make 1,000 bonds available. Each of those 1,000 bonds are worth 100,000 US dollars. Okay, so overall, in total, it is 1 billion US dollars. And I will sell these bonds, and I'll say to everybody, you can buy my bond. I guarantee to pay you back, and I will give you back interest. So you're lending money to the government, and then after 10 years, after 1 year, after 30 years, depends on the bonds they're issuing, we'll pay it back to you, and we'll give you interest. Now, because in the US, it's a very safe government, they've never gone bankrupt, they're probably the lowest risk to go bankrupt in the world. It's an ultra safe investment, so they give you back a very small return. Nowadays, it's slightly higher, to be honest, than it was traditionally over the past 20 years. But nonetheless, this is what bond yields are. So why is this important? Why is this important? I've got a lot of people here saying, how can fundamental analysis help with the NASDAQ? Seems like everybody's interested in the NASDAQ. So how can bond yields help the NASDAQ? Helps you to analyze and determine how the NASDAQ's going to move. Same with the US dollar. So it's very simple. Okay, very simple. What is yield? Okay, bond yield. What is yield? The bond yield is basically, let's get a pen out. There you go. So bond yields is basically if the bond is worth 100 US dollars, and the interest I'm going to pay the person who's borrowing me the money is, let's say, $1 US. So basically the yield is 1%. $1 US, they're lending me 100. So I'm paying them 1% return. Yield is basically profit. But if the bond, increases to being worth 200 US dollars, then actually the yield is worth still $1, but in terms of percentage, $1 of 200 is 0.50. So the yield sees volatility. This is what bond yields are. How is it important though? So higher bond yields strengthen the US dollar. People may say, why is higher bond yields strengthening the US dollar? Now, let's see where everybody here is. I can see we've got some people in Europe, a lot of people in Germany, actually. I've got some people in Nigeria, South Africa, Botswana, Asia. Got a lot of people in Asia here. So let's say all these people, okay? Let's say you're in Africa, okay? In Africa, there's bond yields. Of course, every country has bond yields. There's bond yields. In Africa, they're going to pay you 1%. Now, let's say bond yields in America rise. They were paying 1%, so you're not going to bother buying it because it's the same in your country. But they're going to now start paying you 5%. Very recently, went up to 5%. They're going to start paying you 5%. You're going to say to yourself, forget the bond yields here in my country. I'm going to exchange to the US dollar and I'm going to buy bonds in America. Why? Because they're going to pay me 5% and these stingy guys are paying me 1%. All right, so this is how investors think. So to buy those bonds, they have to have US dollars. As everybody's buying US dollars, everybody's buying US bonds, and so on and so forth, it supports the US dollar. So this is the first thing. The second thing is, if bond yields increase, it's a negative for the stock market. Doesn't mean the stock market is going to decline, but it does mean it is definitely negative for the stock market. So what it could potentially mean is, if bond yields weren't rising, maybe the stock market would have increased 100% in 5 years. But because bond yields are very high, it's still increased, but maybe increased 50% this year. Okay, so keep that in mind. Doesn't necessarily mean it's going to completely collapse, but it still is deemed as negative. So why is higher bond yields negative for the stock market? Now I'll explain. Because when there's higher bond yield, so let's say, for example, you have a bond which is paying you 5%. Are you going to risk buying a stock? Okay, somebody's going to say to you, you've got a bond yield, it's a very safe investment, pays you 5%. Okay, or you can have a stock, it's going to pay you maximum 10% this year. It's not going to pay you any dividends, let's say, this company, because it's a growth-based stock, but there's risk. I can't guarantee anything. You're going to say, I'm not going to risk 10%. I might as well go for 5%. So what actually happens is investors become more interested in the bond market. They start to become less interested in stocks. It brings down the demand for stocks. Whereas if the stock market, if bonds are paying very little, they're paying 1%, a lot of the time, sometimes they pay less than 1%, you're going to say, there's no point buying that bond. It's useless, it's worthless. Why on earth would I buy those bonds? I'm definitely interested in the stock market. So you can see as well how high bond yields influence the stock market as well as currency markets as well. So there's an inverse relationship as well between bond yields and gold. Gold doesn't pay interest. Gold doesn't pay dividends either. So when bond yields rise, gold becomes less attractive as an investment, because investors can earn a return from bonds, whereas with gold, it's just a holder of value. It doesn't pay anything. It's just there to hold value, to mitigate risk. It's there as a safe haven asset. It's there as a hedge against inflation. This is what it's there for. So often higher bond yields can cause gold to decline. If you look at bond yields over the past 4 or 5 months, they've been declining. Look at gold. Gold this week increased to the highest value it's ever been out. So you can see a very good and clear example there. So keep that in mind. We're going to look at bonds very shortly as well, and look at how you can use it as part of every single day-to-day analysis. Now, the VIX and the high-low index, we'll look at this very quickly. We're going to look at this more on the MT5. What is the VIX? The VIX is an index, okay? It has a very clear value. It's not based on an X amount of stocks, so don't think of it like an investment. But the VIX is an index that people use as an indication of risk, okay? If the VIX index is very high and it's increasing, it indicates that people are becoming more scared. People are becoming more scared that maybe the stock market is going to decline. Again, it could be decline for the hour, could be decline for the day, could be decline in the long period. If the VIX is declining, it indicates that people are becoming more confident. So that could be positive for the stock market. Now, that is based as an indication of risk. Remember what I said, risk is the most important thing. The most important thing. If you're able to determine people's risk appetite, that is absolutely amazing. Another indication to help you determine the risk appetite of the market. This is known as the high-low index. What is the high-low index? It's there to determine the market's risk appetite. The high-low index is calculated by measuring the number of stocks within the index, which is at a 12-month high, and the number of stocks within the index, which is at a 12-month low. So for example, if we look at the NASDAQ, there's 100 stocks, okay, within the NASDAQ. Let's look at the Dow Jones, something very different. I like the Dow Jones as well, actually. Dow Jones, 30 stocks. Let's say from those 30 stocks, 5 stocks today are at a 12-month high. Let's say 5 stocks again is at a 12-month high. So the high-low index will show you that actually it's at the 50 mark because you've got 5, so it's at the 50, it's at the neutral, it's even. Whereas if you've got 5 stocks at a 12-month high, and then you've got 10 stocks at a 12-month low, it will drop to a 25 level. 25 level. So it's basically showing it's actually the index is low, and it's saying that yes, there's a lot more stocks at a 12-month low than there is at a 12-month high. So you can use this to determine if there's buyers controlling the market or if sellers are controlling the market. And or you can see if sellers are gaining control or if buyers are losing control. Because for example, a while ago, we were looking at the high-low index being around 70. Recently, we could see the high-low index for the Dow Jones was approximately around 70. I can remember back about a month ago, it was quite low. It was actually at 50. So it was kind of at the break even, but slowly, we could see it improve and improve and improve. So this is showing that risk towards Dow Jones is becoming stronger. So this is again something you can use as part of your analysis. So the VIX and the high-low index, very important. Guys, in 5 minutes, we're going to go to the MT5. I've got 3 questions. Bear with me. So very good question. I'm not going to confirm the calculation to you because it's been since university that I've looked at the calculation, and calculation is not important. And nobody's gone to university like I did for economics. It's not going to benefit you as a trader. But the very good question though, the VIX, could you explain how the VIX measures the appetite of the market? Where does the measurement come from? What is constituting towards the VIX? So I'll confirm. The VIX index is only based on the S&P 500, not the Dow Jones, no other stocks, no other, not the NASDAQ, S&P 500. It is constituted based on the volatility, the up and down volatility of the S&P 500. So if you're seeing a very big market that's up, down, up, down, up, down, up, down, the VIX is likely to become very high. Okay. Also, if you're going to see a massive collapse, again, the VIX is likely to go very, very high. Whereas if you're seeing the S&P 500 performing very well, very clear trend, we are seeing some retracements, but the retracements are very small. The VIX can go very low. So this is what the VIX is being priced based on. How can you use the VIX in regards to the Forex market? There's no direct link, but what you can say is if the stock market is seeing terrible price movements, then maybe the US dollar will perform better. But again, you need to be cautious because sometimes it's the US in general which is seeing lower demand. So there could be that scenario that everything in relation to the US is just down. Oil, gold, US dollar, US stocks, everything just goes down. So you definitely can use the VIX. There's not a direct line of influence, but you can of course use it. Last question. How can we get the high-low index of the NASDAQ? If you go to Google, there's a lot of providers for the high-low index. Most of them, to be honest, the most accurate and the best, I think you have to pay for them. So it's not, for example, like a technical indication, which you can just already have available for you on the MT5. It is a real index. Okay, so the high-low index, you can get it for the NASDAQ, you can get it for the Dow Jones, you can get it for the S&P 500. Most of the time, though, you have to pay a very small fee for it. But you can type it in Google. There may be some free providers as well, which you can get access to. Or, of course, you can pay for it. Interest rates. Interest rates drive the market. Interest rates tonight will drive the market. Remember my words, tonight, a lot of volatility. All the volatility we currently see would change depending on what is going to be announced tonight, okay? So interest rates, do not solely concentrate on changes in interest rates, but how the market is pricing how interest rates are going to change. So I'll give you an example. So what's going to have the biggest effect? Is the biggest effect going to come if, we're seeing this type of price movement? And here, the Federal Reserve says we're going to cut interest rates by 0.25%. Would that see the most volatility? Or will the volatility mainly be down here, where the market starts to believe the Federal Reserve will cut interest rates by 25%. So again, a lot of the time when the news is released, the market moves in the opposite direction, even though it's against the theory. The theory is lower interest rates, positive for the stock market, negative for the US dollar. Higher interest rates, positive for the currency, negative for the stock market. It's very simple. And to be honest, we've seen that very clearly over the past 2 years. 2022, stock market collapsed. I think the Nasdaq was 34% off the top of my head. Why did it collapse? Because interest rates were going sky high. The next 2 years, everybody believed that interest rates will start to decline, and the stock market just flew significantly higher. So we can definitely see that. But most of the price movement happens when people start to believe there's going to be an interest rate cut. So if, for example, today, everybody believes the Federal Reserve is going to cut 50 basis points, but it actually cuts 25 basis points, regardless of the fact that it's cut, which is positive, the market was pricing a larger cut. So actually, potentially, the stock market can collapse, it can decline. Okay, why? Because everybody priced in 50, but they did 25. At the same time, if people priced in 25 and actually cut 50, it's going to go sky high. Or, for example, they may not cut at all, but the market was pricing that there will be 25 today and 25 in November, which is the next rate decision. They may not cut at all. So people may say the stock market is going to collapse because of that, because it's wrongly priced. But if in the press conference 45 minutes later, they come out and say, we didn't cut today, but in November, we'll cut 1%. Okay, so double that what people believed. Then of course, the stock market may continue to increase, even though there's been no cut at all. So you can see here, it's not about just if they're going to cut, when they're cutting, and when they announce the decision, are they going to cut or are they not? It's about pricing in before it happens. And there's lots of different ways you can price it in. For example, here is the Fed Watch tool. It's provided by the CME exchange, so the Chicago exchange basically, and basically showing you what the market is pricing. So for example, here you can see it's for September. This is 50 basis points. This is 25 basis points. Stock market has done very well. For example, the Dow Jones done very well for at least a week and a half. 65% of people believe there's going to be a 50 basis point rate cut. 35 believe there's going to be a 25 basis point rate cut. Nobody believes there's going to be no rate cut. So you can see why the stock market is improving. Okay, but now it's about what is about to happen. Okay, but you can use these tools to see how the market is pricing and what is the possibility. And as these change, if you know the 65 suddenly increases and becomes 85%, then of course that will create volatility, and we can use that. So keep that in mind. And we're going to look at this as well in a moment. So other fundamentals, very quickly, last thing, this is the last page, we're going to go straight to the MT5. So fundamental factors that you can also look at. Geopolitical tensions. JP Morgan spoke overnight for us in Europe and in Africa and in Asia. JP Morgan CEO came out and said, the biggest driver at the moment is geopolitical risks, geopolitical tensions. Definitely we have to keep an eye on that. Economic data, which can have a domino effect within the market, mainly inflation, employment, GDP. Those three are the most important. Inflation, GDP, employment. Currency fluctuations, we can look at as well. Global trade tariffs, okay, also known as trade wars. The last time we had something of that which was a very big development was July 17, when the Biden administration actually came out and said we're going to put a lot of tariffs on Chinese goods. I put a red line here when the news was released. This is when the news was released. You can see the stock market just collapsed there after. So bear with me, guys. Let's go to our MT5. Let's go to 2-hour time frame. Now, here we're looking at the NASDAQ. The NASDAQ is actually kind of forming what is known as a head and shoulder pattern. We're currently at a neutral level on the RSI, on the NASDAQ, because we can see we're getting higher lows, but so far we're getting lower highs. So we've got higher lows here, but we've got a high here, and we've got a high here. So the high is lower, the low is higher. So with that gives us a neutral indication. We're above the trend line, which is a 75 bar, 60 here. Let's make it 75. So there we have 75. 75 bar exponential moving average. So we're above that, indicating an upward trend. We're above the 100 period, which is the sentiment line, indicating buyers are controlling the market. And we're at the neutral on the RSI, we're at 50. So no real indication there. The only thing which is a concern on the RSI is we're looking at divergence. This has gone lower, whereas this has actually gone higher. So that's divergence. So that's a slight concern. But we can see here, we're mainly at a neutral. So how can we use fundamental analysis to help us? Now, first thing, if we go to Google, type in CME FedWatch tool. CME FedWatch tool. And by the way, you have to look at this for months and months and months. The more you're looking at it, the better you're going to learn how to use it. So here's the FedWatch tool. We've got 3 rate decisions this year. We've got 18th of September, 7th of November, 18th of December. So 18th of September, now, previously this was 65%. Now it's 61% that believe it's going to be 50 basis points. 39% believe it's going to be a higher level. So this is something for us to take into consideration. Now, we have to take into consideration it is it's lowering. So that is something which is negative for the stock market. As long as it continues to lower, if this becomes over the next few hours lower and this becomes higher, that can be something which is considered negative, because 50 basis points is currently mainly priced and people are starting to move away from it. So this is the first thing that we can look at. Now, once the announcement is made and the press conference is done, the main thing we need to look at is for November, okay? So November, this here is 75 basis points. This here is 50 basis points. This here is 1% cut from now all the way to November. Now, let's look at two scenarios. If this vanishes here, nobody thinks 1%, or very few people think 1%. This drops to maybe 40%, and this becomes the main scenario. That's something which potentially can be negative for the stock market or pressure slightly the stock market. Again, doesn't necessarily mean the stock market's going to collapse and we're going to see a massive downward trend, but it's something negative. Why? Because people are becoming more hawkish in regards to interest rates. Let's look at a different scenario. Let's say 22% that think there's going to be 50 basis points up to November. Let's say that drops to 10%. Let's say this goes up to 60%. Let's say this goes up to 36%. That is something which is positive, okay? And that for November is something very important when there's the press conference, which is 45 minutes after the announcement. So this is the first thing we're going to look at while analyzing the chart, especially in regards to the stock market. The next thing, US bond yields. We are very clear. Higher bond yields is negative for the stock market, lower bond yields is positive for the stock market. Bond yields today, guys, it's up, okay? Yes, bond yields are much lower, it's declining. You can see it's been declining since May onwards, big declines. Today, 45 points up. That's a slight negative, ladies and gentlemen. So here, potentially we've got something negative because this is slightly dropped to 61%. Ideally, we want to see a larger drop, but that's a slight negative. Bond yields are low, but they've slightly increased today. So that's again a slight negative for the stock market as well. Let's now go to FinViz. People said to me, if I can look at FinViz, of course, I will keep my promises. Let's go to indices. Okay, so here I look at indices. Let's actually click on it. Here I'm looking at indices. Now, the DAX, more or less unchanged. Okay, so no gains there. Euro Stoxx 50 decline today. The Nikkei declined today. The Dow Jones is declining today as well. These three here are increasing. Well, actually, S&P 500 0.04 is nothing to brag about. These two here are increasing. But like I said, these three are decreasing. Here's the VIX. The VIX is 0.09% higher. It's not much. But if it gets higher throughout the upcoming hours, and especially if the DAX drops lower, and that's, and again, another indication that maybe we're going to see some weak price movement, okay? Last thing I would look at as well is currencies. Let's look at the value of the US dollar. US dollar is down, ladies and gentlemen. So you can see here, that's something else you can also use as well. Best performing currency today, by the way, is the British pound against, and also the New Zealand dollar. These are the best performing currencies of the day. People say to me a lot of the time, what's the best performing currency of the year? The best performing currency is actually the British pound, believe it or not, of the year. Now, let's go back to the New Zealand dollar. So, go back to the NASDAQ. So there is certain factors which is indicating to us that actually maybe we're going to see some weakness. So that's something we can take into consideration. But like I said, again, here we can see that actually we're above the trend, we're above the sentiment line, we're even above the neutral line on the RSI. So if we are going to look at downward price movement, then we can take into consideration maybe potentially the support level here, because that's in line with the support level and it's also in line with our trend line as well. Some people that want to maybe lower the risk, what they can also do is if they want to speculate downwards, they can not look at the support level, but look at 75% of that. So instead of looking at 0.70%, they'll take into consideration, for example, 0.53%, which is a slightly higher level. So it lowers the risk that way. So this is something people can take into consideration, like I said. But we need confirmation from price movement, not just to be looking at the fundamental factors as well. So here, to be honest, is 50-50. So people speculate in a decline, depending on where they're entering. You know, if they're entering in this area, this area and above, probably have had a great day. If they're entering the decline somewhere down here, maybe they're not doing so great. So if we're going to see upward price movement, and we're going to go to here to this resistance point where we found resistance on 1, 2, 3 occasions, but we can still see the VIX is getting higher, bond yields are getting higher, CME FedWatch tool really starting to price in higher interest rates and a lower cut. Then when we get to that area, maybe potentially somebody may say, you know, if we get to this area, I will see where I can then take into consideration a decline. How can I do so? Maybe they'll switch over to a 1 minute and say, you know, it's crossed over upwards. When these two moving average cross over downwards, that's why I'll speculate that we're going to see a decline. Maybe they'll say, you know, if it's up, you know, it's trading up here at this red line, if it crosses below the 250 simple moving average, which is the orange line here, that's the area where I'll speculate short term, just very short term, a decline. For example, if it declines to somewhere here, let's say, because don't forget, we're saying if it increases all the way up to here. If it declines to here, you know, they'll take into consideration, for example, like this, 0.15%, which is typical for day short-term trading. So here you can see exactly how I'm taking into consideration fundamental analysis while analyzing the market as well. This is how I'm using that, ladies and gentlemen. Let's look at some questions. Guys, we're going to end the webinar in a few minutes. So if you have questions, let me know now. Somebody says here, why is the VIX inverse to the NASDAQ? Because the NASDAQ is correlated with risk, ladies and gentlemen. So that's why it's inverse related to the NASDAQ. Because if there's high risk appetite, the NASDAQ tends to perform well because it's a risk-based asset. If there's low risk appetite within the market, it tends to perform poorly. So that's the answer to that question. Guys, if there's any other questions, feel free to ask. I will leave just a few more minutes for people to ask any questions. Any other questions, ladies and gentlemen? Is the ADX similar to the VIX? No, it's not. The VIX isn't a technical analyst. It's not part of technical analysis. What can we expect from the rate decision today? We had a poll. Let me quickly get the poll up where everybody voted. From the poll, 78% said 25 basis points, 22% said 50 basis points. If we look at the CME FedWatch tool, like we looked at just a moment ago, 61% of traders believe there's going to be 50 basis points. So that's quite high, not what our traders in today's webinar watchers believe. In regards to economists, Bloomberg actually did a survey today, and they asked the 115 most respected economists in the US, 115, and from those 115, 104 said that there's going to be 25 basis point cut, not 50. So really, traders think something very different to what economists believe. So what that means in terms of the NASDAQ, it depends what people are pricing into the market. By the looks of it, a lot of people are pricing in a 50 basis point rate cut. So if 25 comes, then that can be something potentially negative. But if it's going to be 25 basis point rate cut, and in the Federal Reserve press conference and say, you know, it's 25, I know people are waiting for 50, but don't worry because there's going to be a lot more rate cuts coming. then maybe it's not going to be that negative. So we need to really play with the different factors within which potentially can happen within the market. But again, what a lot of people can do is, they say to themselves, if it goes to an X price, then I'll speculate and start speculating an increase. If it goes to a separate price, I'll start speculating a decrease. For example, somebody may say, again, if it's going to drop below here, I'll start speculating decline all the way to here. If it increases above, for example, here, let's say, just for example, then I'll start speculating upward price movement here. So you should be prepared no matter what type of price movement. Just as an example, like I showed now, no matter what type of price movement there's going to be. When you're using moving averages, which time frame should you use? All time frames, all of them. Minimum at least 3 different time frames. A longer term, a medium term, and a short term. For example, daily time frame, 2-hour time frame, 4-minute time frame, for example. Who can assist with one-on-one coaching and sessions? Of course, you can request a session with me, with your account manager. So message your account manager, say I want a one-on-one session with the analyst Michalis. More than welcome to provide that. You can message the support team as well, and we can get that arranged. So through the live chat or via email, that's absolutely fine as well. Somebody says, some people said I answered too late. Will I get a copy of the recording? We will send a copy of recording tomorrow. Another person says here, what are the values of the RSI on the screen, of the moving averages on the screen? The blue one here, which is the trend line, is a 75-bar exponential. Moving averages here is a 100-bar simple moving average, and that's a price sentiment line. This is for the 2-hour chart. For the 1-minute chart, which I was on, we've got a 250 simple moving average. This here is an 80 moving average. This here is an 8 moving average. Somebody here says if they can, I can give them a strategy. Today, we're not looking at strategies. Today, we were looking at fundamental analysis. But if you go to HFM webinars, like so, click on here, either or anyone will do. You can see there's a lot of webinars. Some of them are based on strategies. For example, advanced swing trading strategy, how to read and analyze charts on the MT5, swing trading, day trading, scalpers trade, controlling management, controlling emotions, developing my first trading plan, trading with double Bollinger Bands. There's a lot of strategies on different webinars. Today, it's not about strategies. It was about fundamental analysis. Somebody says it's not possible to arrange with you directly a one-on-one session. You have to speak with your account manager. So everybody has an account manager. He has access to my calendar, and he can book you in for a one-on-one session, because there's a lot of people that request one-on-one sessions with me. So each account manager can see my diary and they can book you in with a one-on-one session. So guys, let's end today's session because we've answered quite a lot of questions. Thank you for your questions. Very good questions. Tonight's going to be a very interesting day. Very interesting day. In the meantime, hopefully you found it educational and this helped you. What I will say is one webinar is not enough to help you. People that watch a lot of webinars day after day after day, they watch webinars in their own time. That is where you really start to feel webinars are becoming helpful, because one webinar is based on a strategy. Today's webinar, fundamentals. The next webinar is going to be based on emotions. The webinar after that is going to be based on trading plans. So, one lesson, should we say, is not going to tell you everything. More is needed. So this is the end of today's session. Enjoy the rest of your day. I wish everybody the best of luck. Take education very serious. If some people here say, I really want to take the next step because I've gained a lot of experience, but I just don't know how to advance. If you do want to advance your analysis, then also order flow analysis is a very big factor that you can look at. But we will, of course, have different webinars based on that as well. So in the meantime, enjoy your evening, trade safe, trade responsibly. If you ever need any assistance, feel free to get into contact with us. In the meantime, though, goodbye.